Hello, and welcome to another episode of ETF360. I'm Kirsten Chang, Senior Industry Analyst at VettaFi, and today I'm pleased to be joined by Barry Peters of Winslow Capital to discuss two ETFs, IWFG and IWLG. Barry, thanks so much for joining me.
Thanks for having me on today.
So, New York Life Investments has teamed up with Winslow Capital to provide investors with two fully active ETFs. Now, these are both large cap growth ETFs. That's the Niley Winslow Large Cap Growth ETF, IWLG, and the Niley Winslow Focused Large Cap Growth ETF, IWFG. Can you tell us more about these two funds, what these strategies entail, and what the benefits are of an actively managed ETF structure?
Sure. Both strategies provide actively managed exposure to the large cap growth asset class. The big difference between the two strategies is their level of diversification. IWLG is a little more diversified and typically holds between 40 and 50 companies, while IWFG is more focused or more concentrated and typically owns closer to 30 holdings. We think the benefits of both strategies lies in their active management. Large cap growth indices today have never been more concentrated than they are currently. That level of concentration comes with increased levels of risk. Also, I think it's safe to say that the rate of innovation in today's economy has never been greater. At Winslow, we believe it's important to be able to adapt and adjust to these ongoing innovations in real time, as opposed to locking in a static portfolio that might only adjust or rebalance on an annual basis.
Yeah, that's a great point. There's been a lot of talk, to your point, about concentration risk around Mag 7 and those mega caps. And we've also seen evidence of a rotation out of growth and into some small cap values. So why is now still a good time to look at the large cap growth space? Why is there staying power there?
Look, we think large cap growth is an advantaged asset class, very simply put, due to its superior earnings growth. And that's an advantage that compounds over time. If you think about it simplistically, that's why people invest in equities, right? To participate in the long-term earnings and free cash flow growth of the companies they hold in their portfolio. To put some numbers to that concept, over the past 10 years, ending in 2023, the Russell 1000 Growth Index saw a cumulative increase in its earnings of about 150%. That growth rate was almost exactly 3 times that of the Russell 1000 Value Index, which grew its cumulative earnings at closer to 50%. That's a tremendous advantage. Another advantage is the profit margin gap. Large cap growth as an asset class turns every dollar of top line revenue into a greater bottom line profit versus other asset classes. So superior growth rates that come with higher profitability is a potent combination in driving performance.
And obviously, the large cap growth trade has been a crowded one all year. So what sets these two strategies apart from other large cap growth portfolios?
We think what makes them unique is Winslow's no preferred habitat approach to growth investing. With our approach, we diversify our portfolios across what we believe to be three different yet complementary types of growth companies, those being consistent growth, dynamic growth, and cyclical growth. We then allow ourselves the flexibility to overweight or underweight each of these types of growth to manage a portfolio that's capable of generating strong, consistent results.
I have to ask about the AI angle. AI has been the hottest theme of 2024. It seems like everyone wants a piece of the AI pie these days. So how are these two funds, IWFG, IWLG, positioned to take advantage of the continued growth and adoption of AI?
Yeah, what's interesting is, look, today's AI beneficiaries may or may not be tomorrow's beneficiaries. Right now, there's a lot of emphasis being placed on chip manufacturers, right? Companies whose products facilitate the heavy lifting that's required for generative AI or large language models. But tomorrow, that might not be true. We think AI leadership over time will change and evolve, including who owns and who can monetize large pools of accurate data and who might have the large client base to then license that data to. What I can tell you is an actively managed strategy has the ability to adapt to this rapidly changing landscape.
Absolutely. And from a practical standpoint, how should investors begin thinking about implementing these funds in a balanced portfolio? Should they approach them more as core strategies or treat them more as supplemental?
Yeah, I honestly think both of these strategies can be utilized as a core growth holding. IWLG, again, is a little more diversified, while IWFG is a little more concentrated, and as a result, will likely be slightly more volatile. But both offer a style pure option for investing in U.S. large cap growth equities.
All right. Thanks so much, Barry. That does it for ETF 360. My thanks again to Barry for joining us, and thank you all for tuning in to watch. We'll see you next time right here on ETF 360.
Welcome to another episode